He may have left RBI, but Raghuram Rajan's managed to fire another reform salvo, a bunch of steps to broaden and deepen the corporate bond market last week. It has allowed banks to provide up to 50% credit enhancement to bonds. What it means effectively is underwrite up to 50% of a corporate bond. It has permitted brokers in corporate bond repos, forced large borrowers to borrow part of their needs through bonds. The ultimate reform promised is that the Reserve Bank has moved the government to amend the RBI Act so that it can accept corporate bonds as collateral in its repo window. And of course, there were more steps. Banks can issue rupee bonds or masala bonds in foreign markets to raise capital and to finance infrastructure and affordable housing. Primary dealers will be provided money to make market in illiquid government securities. FIIs can now directly buy or trade in the G6 market, government securities market. And in the forex market, of course, companies can hedge up to $30 million without practically very little documents. And they can keep open positions of $5 million, something that's never been allowed before. So how much does all this add up to? Is it a big bang or a mini bang, as Governor Rajan himself put it? And what are the steps forward? To discuss that, I have Mr. H.R. Khan, author of the Khan Panel on bond markets, which actually was what Rajan was largely implementing through his steps, and two other veterans of the bond market, the Deputy Managing Director of Axis Bank, Srinivasan, Varadarajan, and Hitendra, Head of Global Banking and Markets at HSBC India. Well, thank you very much, gentlemen, for joining me. First up, let me start with you, Srini. What was so game-changing about the bond market steps?
I think, as you said, it's in some sort of a mini bang, and clearly we have made good progress on a lot of fronts. While I think you called it reform in the corporate bond market, if you look at each of the measures, I think the biggest, in my view, which is to some extent game-changing, is the FX side actually. Doing 30 million without underlying and a 5 million open position across corporates and the number of corporates we have and what they can do, and in terms of 30 million without underlying, makes things life very simple for a huge cross-section of corporates. And I think that, in my view, is the biggest reform as far as this package is concerned, in my view. Though the focus is on corporate bonds, I think tucked away the FX reform there, I think has clearly some game-changing attributes.
Okay. Yeah, but Hitendra, what would your thought be? I mean, I take your point that this is providing huge liquidity to the markets. Hopefully, there will be two-way views from corporates. But Hitendra, on the corporate bond market itself, you don't think this has any game-changing attributes like that forcing corporates to get into the bond market because banks' tap will close?
No, absolutely. I frankly think, a lot of us have participated in attempts to divide and deepen, make the corporate bond market more vibrant. And we've all struggled, and we've all given a list of issues that need to be done. And frankly, you have to give enormous amount of credit to the Khan committee and Mr. Khan himself for covering almost every aspect that anyone thought is needed to make the market more liquid. And, we have so far seen only the measures announced by the Reserve Bank of India. That report also lists a lot of measures that are needed to be taken by SEBI, by Government of India, by PFRDA, IRDA, etc. But the number one thing, I think, is that corporate bonds, unlike in other parts of the world, did not have the ability to, you couldn't refinance those. If you went to a bank to borrow against a bond, you got the money at an MCLR or a base rate, as the case might have been, and invariably that's much higher than the yields on the bond. So the fact that you have generated refinance or leverage, it really is a phenomenal step. And taking a step further, I really hope that when they finally announce the LAF guidelines on what kind of bonds are available, I really hope they try to make it slightly more liberal. Now, I know this is really pushing central bank boundaries, but AAA rated bonds are not where the problem in India is. The problem in India is as you go down the curve to AA, A+, this is all investment grade stuff. So I think if you see once again the report which has said rating agencies can tap information from the CICs, and if that information is available, the confidence of investors will increase, and if those bonds lower rated with the credit enhancement albeit, if they're eligible for some form of refinance through regulated entities or through market repos, which then go into the regulated entities, I think it can actually be quite a game changer. I think we have to get something big
I'm
here.
sure that they are not thinking down that curve at the moment. It is only AAA. That's I'm privy to that information, but I guess further down. But actually, since Mr. Khan is here with us, Mr. Khan, actually, Hitendra, generous praise from him, but he pointed to that rating agencies. Don't you think there were some glaring omissions from your panel report? For instance, exactly this. Rating agencies should be given access to the acrylic, and they should know the list of SMA2 accounts, people who have defaulted in 60 days, that they should make weekly disclosures regularly. Aren't you a little upset that some of these low-hanging fruits were not implemented?
No, quite a few things. Let us look at this way. There are few things which have been announced, which are in the RBI domain. They have been announced. Few things are still in the RBI domain. We have to work further. One example is what you mentioned about CRAs being allowed to CRILC. There are legal issues involved there, so it has to be examined. So that is one. The other thing is that there are some good practices which they are required to follow. For example, on a quarterly basis, they have to, at more frequent basis, they should disclose what has happened to the rating. So I think SEBI will take action on that. And similarly, there are recommendations which comes under the SEBI's domain, government domain. For example, the stamp duty part, I think government is very seriously seized of that. So that part will come. So this is, I will not say this is in one shot everything is done and there is nothing else to be done. So that it's a process which has started. And the other one which we had very strongly mentioned about CDS, the netting aspect. There is no specific point in this press release, but then as I mentioned, it has to be examined, because whether it can be done under the existing legal framework based on legal opinion, or amendment has to be moved.
One would have expected netting of derivatives. Even that netting was not announced.
Yeah, I meant netting, yeah. Netting, which is very, very crucial not only for CDS but the whole host of derivatives.
Is that a very big issue? I mean, netting of derivatives, my sense is, or does it require legal changes? Is that why it didn't come?
Yeah, I think India is still not a netting eligible jurisdiction, as they call it, and therefore in terms of market participants, providing capital will be on gross basis, and to that extent there is an issue in terms of how exactly, and there are case laws in terms of whether you can net payables versus receivables.
At the FEDI meeting, wasn't there a commitment given that those legal changes also will come?
I think in the Khan committee report, it specifically mentioned that this aspect needs to be looked into, as Mr. Khan is just mentioning. Also, even the governor in the remarks yesterday has actually mentioned that, this is what we have done, this is what is in the pipeline. So, I think, you have to say, I'm assuming that almost all the committee recommendations are likely to be accepted, going by the evidence on record for the last 2 days. And therefore, if you see the totality, what will happen, you will have the electronic platforms, you will have DVP, DVP3 introduced for corporate bonds, you will have potentially credit rating agencies joining the membership of CICs or whatever the legal issues that needs to be sorted out. I think if you see the totality of all of these, you're effectively saying a rating agency is not only going purely by future projections, it will actually have access to live data. That's a very material confidence booster to especially when you're trying to widen participation in bond markets. And netting is, yes.
The governor was a little skeptical yesterday at the FEDI speech on whether credit rating agencies can be given access to acrylic. There, the corporate clients have that right of confidentiality over their relation with the bank. So that I don't know if it will come that easily, even if the RBI Act changes come. But Srini, you think if it is very clear that corporate bonds are going to be accepted by RBI, that legal change is coming. If that were to come, and even assuming we started with AAA bonds only with haircuts, you think it's a substantial push, as Hitendra says?
I think funding, when you get it at a much cheaper rate, meaning basically when there's positive carry. Right now, if you're borrowing deposits or other source of funds investing in corporate bonds, to some extent, in the high-rated bonds, you could maybe end up having negative carry. If that is cut out, like in G6, clearly the ability to hold over a slightly longer horizon increases. As Hitendra is saying, I think the investor side reform also needs to happen to make sure that the market, meaning you're increasing the ability for people to hold as intermediaries, you're increasing the supply side. Now, how do you increase the demand side? And I think that is also an important thing, because if supply increases, intermediaries hold, but if ultimately the demand doesn't come through, I think the system chokes up. So I think everything has to happen in unison, and I think the supply and the demand side also needs to get going.
I'll come to the demand side in just a minute. Let me come to the other big announcement that came last week on the large exposures, and the fact that starting 2018, banks will not be able to lend more than 50% of outstanding loans to some of these big groups. Over 25,000 crores would be a lot of companies and groups. Now, if that were to happen, is there enough steam in that proposal to really expand the bond market, maybe even the junk bond market?
So I think that's why I mentioned, I think whoever, the committee has obviously, or the Reserve Bank of India has obviously seen it in its totality. You have to recognize that the banking system is the dominant provider of financing to the corporate world. Now, you cannot simply say we will not do so from 17, 18, 18, 19 and 2021, and 2021 is something like 10,000 crores. That's an amount at which a fairly sizable population of corporates would fall in. So therefore, along with that, this partial credit enhancement has been increased. Now, you've got to see it in totality. And therefore, when I was talking about, I hope Reserve Bank of India in drafting its own LAF guidelines, at least bonds guaranteed by, let's say, their own regulated entities, are they eligible for LAF or not? I read the guideline where it suggests that banks are not expected to buy bonds credit enhanced by other banks. So clearly the intention is to diversify risk away from banks. And therefore, I think if you have, to Srini's point, if you have intermediaries who are not banks and not PDs, let's say, who have bought these bonds, what you need is a private repo market where they can repo, possibly counterparties being banks and with PDs, who can then refinance at the private rates market will be the private rates market, and it can sometimes be above the policy rate. What you want is a certainty that you can refinance at close to policy rate from the Monetary Policy Authority, and therefore that chain, I hope, is established that regulated entities can undertake repos in private repo markets or the electronic platforms. Once they acquire a certain collateral, that collateral which is eligible to be refinanced once again with RBI will naturally then get, and I certainly hope as a starting point, apart from AAA, it's understandable that AAA is a starting point, but I would actually go a step further and say, if you have 50% credit enhancement from your own regulated entities, is the lender of last resort really taking any genuine credit risk? So, and we are talking about overnight and 2 days here.
Sure.
So the one thing is that 25,000, when you're looking at 25,000 as a limit to start with, I think we shouldn't confuse entities with groups. I think the number of entities who will have banking system exposure in excess of 25,000 crores is just going to be less than a handful. I don't think so. It'll not be more than the numbers in my hand, possibly in one hand.
Okay.
So to that extent, I think it's a slow process in which they're guiding large entities to the 10,000 crore, which is probably in FY20 it'll be just over $1 billion then.
Exactly.
So that could be a larger number, and by which time the bet is that the markets are open enough to sort of absorb that supply. And I think it's a
actually they counted only 4 entities in my private conversation. I think it was the steel companies and 2 telecom companies. Only they are really above the 25,000 crore if you take single entities. So I think that is the idea. But we have to take a break. I'm coming back to check whether the Reserve Bank should have put these gross numbers of 10,000 crore. Maybe it should, by the time we come to 2020, 10,000 crore may not be worth much. And also this masala bonds, and whether there is a rupee yield curve that we can foresee in the near term. All those questions to Mr. Khan and to my guests in a minute.